Hey everyone, James here. Welcome back to your James Ag. I want to get straight to it because what we're seeing in the metals market right now is, well, it's alarming. Before we dive in, a few critical disclaimers. I do not manage money. I do not offer investments, and I will never ask you for any payment anywhere. If anyone claiming to be me or associated with this channel asks for money, it's a scam. Block them immediately. No DMs, no payment requests. Always verify independently. This is about information, not hype or guarantees. If you're here for quick buy-sell calls or sensational price predictions, this isn't your place. This is for serious, independent thinkers, people who want to understand the plumbing of the global financial system, how paper versus physical markets behave, and where systemic stress can appear before it hits mainstream headlines. If that's you, comment OG in the chat or below, and while you're at it, share your location. It helps me see where engaged, analytical viewers are coming from, and it helps build a community that actually cares about facts, not memes. Now, why am I sounding so urgent? Because right now, we're seeing signals that sovereign debt instability, the core plumbing of global finance, could trigger a chain reaction impacting gold and silver markets in ways many people aren't prepared for. And this isn't fear-mongering. Historically, when debt stress forces central banks to inject liquidity and create new currency, hard assets respond. This is basic macro mechanics repeated over decades. Gold acts as the anchor, the wealth preservation tool. Silver? It's the volatile wild card. Smaller market, higher industrial demand, historical undervaluation relative to gold, all ingredients for a potential explosive move. Here's the key point. This channel focuses on reality, not promises. Physical gold and silver behave differently than futures contracts or ETFs. Ownership of physical metal is not a ticket to instant gains. It's about security, optionality, and strategic positioning. You must understand the distinction between paper claims and tangible holdings. Too often, market hype blurs that line, and we'll keep it crystal clear here. I also need to pause and stress one more time. No one should be reaching out to you with special deals, private groups, or signals. The market has impersonators everywhere. Always check sources. Always verify. Protect your capital from scams before worrying about markets. That said, let's get into what makes this moment unusual. Bonds, sovereign debt, are behaving like a tripwire. Stress is building, and if it crosses a threshold, central banks historically respond with liquidity injections. That creates what we call rocket fuel for precious metals, and while gold moves steadily, silver reacts faster due to its smaller market size and heavy industrial use. Think of it as a tightly wound spring, ready to release energy. I want to hear from you in the comments. Are you stacking physically, watching paper markets, or simply observing? Type your approach and your location. This is not for casual hype traders. It's for people who want to understand the system and act with knowledge rather than emotion. Finally, remember, the content here is about analysis, not action. We're mapping structural risk, system stress, and dislocations between physical and paper markets. Every viewer should do their own research and decide based on their own risk tolerance. There are no guarantees. This is education, strategic awareness, and in the current climate, that's invaluable. So if you're ready, stay tuned. Over the next sections, we're going to break down the specific market dislocations, the numbers behind COMEX and Shanghai inventories, supply-demand stress, and why the bond market could be the hidden lever behind the next repricing of precious metals. But before we go there, make sure you're in the mindset of independent verification. Comment AG, tell me where you're watching from, and buckle up. This isn't everyday volatility. This is system-level stress, and understanding it early is the advantage. Invest with logic, not hype. And remember, if someone claims otherwise, it's a scam. Stay alert. Let's jump straight into what's happening right now, the event that got my attention, and why you need to understand it. We're seeing a classic market dislocation, but on a scale that's rarely discussed outside institutional circles. Take gold and silver pricing in relation to sovereign bond stress. Bonds in key economies, particularly US Treasuries, and certain European government debt, are flashing red. Yields are spiking in a way that normally signals either confidence erosion or forced liquidity moves. Here's the kicker. Gold hasn't fully reflected that stress. Silver, meanwhile, is showing erratic pricing that looks more like an industrial demand signal than a traditional safe haven response. Put simply, why is the stress showing up in bonds but not fully in gold and only partially in silver. That's a dislocation. Normally, when bond yields spike due to solvency risk or liquidity stress, gold and silver immediately respond. The historical correlation is clear. But right now, the disconnect between the debt market and the metals market is unusually wide. This is the type of event that institutional players monitor closely because it often precedes sudden repricing, the market's way of catching up to the underlying stress. Another factor, physical market stress is starting to appear regionally. In Asia, premiums on physical gold over paper prices are widening. India and China are both reporting stronger than expected physical demand, while COMEX inventories remain near multi-year lows. Registered gold stocks that are eligible for delivery are barely moving, while open interest in futures is climbing. This divergence between paper claims and physical availability is a textbook warning signal. Liquidity risk is growing in futures markets. When the paper market can't efficiently deliver metal, the system strains, and that strain doesn't always show up immediately in prices. Silver is even more interesting. Its global market size is far smaller than gold's. When industrial demand from solar panels, EVs, electronics, and defense collides with paper market distortions, you see price anomalies that aren't reflected in ETFs or COMEX futures immediately. In other words, silver can behave like a wild card asset. Small changes in physical availability can trigger outsized market moves. Historically, these are the kinds of moments that create explosive short-term volatility, but the underlying structural story is long-term: constrained supply, high industrial usage, and persistent undervaluation relative to gold. This is why I'm sounding the alarm. The system is showing stress signals in multiple layers: sovereign debt, central bank liquidity, futures versus physical inventory, and regional premiums. Each one on its own might seem normal, but when they converge, you get a dislocation event. Let's also look at the geographic arbitrage angle. In Asia, gold is trading at a consistent premium over London or COMEX prices. That gap isn't just a few dollars in some reports, it's historically significant for retail and wholesale buyers. This suggests that physical metal is moving faster than paper pricing can account for. Arbitrage opportunities exist, but the underlying reason is stress in physical flows. Metal isn't magically appearing. It's being held, transported, or claimed faster than the system can equilibrate. The core takeaway here is this: we're at a point where paper markets and physical markets are speaking two different languages. Futures contracts, ETFs, and leveraged paper positions are not yet fully reflecting what's happening in real-world demand and supply. And when the two eventually reconcile, often suddenly and violently, the repricing can be sharp and nonlinear. That's exactly the type of situation where someone who only looks at charts or news headlines might completely miss the systemic signal. This dislocation is also tied directly to the bond market tripwire I mentioned earlier. When sovereign debt stress hits thresholds that force central banks to inject liquidity, it historically sends a clear signal to gold and silver. But if physical metal is already constrained, that liquidity acts like rocket fuel. Prices can gap sharply before any broader market consensus catches up. So here's the urgent framing. We are not talking about normal market noise. This is a layered structural anomaly. One layer is the debt market, another layer is physical metal availability, another layer is regional premium stress. Add industrial demand to the mix, particularly for silver, and you have a situation that qualifies as a serious, high-conviction dislocation. In the next section, we're going to dig deep into institutional-grade data, COMEX inventories, open interest, Shanghai Gold Exchange flows, MCX India, and silver supply-demand metrics to see exactly how this dislocation is manifesting numerically. This is where the theoretical concern becomes measurable evidence. Remember, this isn't hype. This is data-driven. If you own gold or silver physically, or even follow paper markets, understanding this divergence is crucial. The system is signaling, and it's speaking through anomalies, premiums, and supply constraints, all before prices catch up. Now that we've identified the dislocation, let's ground it in hard data, numbers, flows, and structural stress points that reveal the true state of the precious metals markets. We'll look at gold and silver separately, comparing physical versus paper layers, and why the current signals suggest systemic tension rather than normal volatility. Starting with COMEX, the US-based futures exchange, registered gold inventories, the metal actually available for delivery, are near multi-year lows. Eligible stocks, which are technically deliverable but often not moved due to strategic holdings, are only marginally higher. Open interest on COMEX, meaning the number of contracts outstanding, has been climbing steadily. That creates a delivery strain. Paper contracts increasingly exceed available metal. Historically, when open interest outpaces registered inventory by these magnitudes, there's a higher risk of delivery stress. The system's plumbing starts to creak. Silver presents an even sharper picture. COMEX registered silver inventories are extremely tight relative to open interest, producing a deliverable supply ratio that is well below historical norms. This isn't just a minor technicality. Silver's smaller market amplifies any imbalance. A few thousand ounces diverted or withheld can create outsized price reactions. Add in the industrial layer, solar panels, EV batteries, electronics, and defense applications, and you have a real-world demand shock layered on top of an already thin paper market. Looking east, the Shanghai Gold Exchange, SGE, tells a complementary story. Physical withdrawals and imports have surged in recent months, particularly in mainland China. Premiums on allocated metal trades have risen, indicating that buyers are willing to pay above global benchmark prices to secure tangible metal. This isn't speculation, it's documented flows. Bullion bars leaving vaults faster than paper records would suggest. SGE data also shows that domestic demand often eclipses local production and imports, pushing the market toward a structural deficit that paper prices do not yet fully reflect. India adds another layer of stress. According to MCX, India reports consumer and wholesale buying remains robust despite seasonal fluctuations. Jewelry demand is strong, investment bars are moving, and local premiums have widened. India is a major physical market, and its premium versus international benchmarks is a signal of physical scarcity relative to paper claims. These premiums often spike before the West recognizes systemic tension, a clear example of geographic arbitrage in action. Now, turning to silver supply-demand fundamentals, the Silver Institute reports a persistent deficit in global mine supply relative to total consumption, particularly when factoring in industrial applications. Recycling partially offsets demand, but not enough to close the gap. Historically, these deficits align with periods where silver experiences rapid repricing relative to gold, precisely the scenario we see today with paper markets misaligned with physical stress. The CFTC Commitment of Traders, COT, reports further clarify positioning. Commercial hedgers, typically miners, refiners, and institutional participants managing physical exposure, are holding significant net short positions in paper markets. Non-commercial traders, which include hedge funds and speculators, are heavily net long. This divergence indicates that the paper market is increasingly speculative, while physical market participants are acting on real-world supply constraints. The imbalance is measurable and growing. Let's tie this together. COMEX Gold, low registered inventory, rising open interest, delivery strain. COMEX Silver, critically tight industrial overlay, volatility risk. SGE Gold, high withdrawals, rising premiums, physical scarcity in Asia. MCX India, robust local demand, widening premiums, regional arbitrage. Silver Institute, structural deficits, industrial consumption, long-term underpricing. CFTC, commercial shorting versus speculative long, paper versus physical divergence. The macro implication is clear. Physical demand is overwhelming paper pricing, creating a structural mismatch. Futures markets can mask real-world shortages for a time, but when the system adjusts, repricing occurs rapidly and often violently. Geographic arbitrage, Asia versus West, COMEX versus SGE, is already revealing the tension. Liquidity in futures markets is under pressure. The longer it persists, the sharper the correction when the two sides converge. This is why I emphasize strategic differentiation between physical and paper holdings. Holding paper contracts, or ETFs, gives exposure to price movement, but does not insulate you from delivery risk or regional scarcity. Physical holdings, secured through reputable channels, are the tangible response to the systemic pressures outlined here. At this point, the data speaks for itself. Inventories are tight, industrial demand is rising, physical premiums are diverging from paper pricing, and global flows show sustained stress. These aren't minor market blips. This is structural tension visible in the numbers. Next, we'll provide a technical snapshot, not as trading advice, but to show how these data-driven pressures manifest in market structure. RSI, moving averages, Ichimoku clouds, and volume profiles will be mentioned briefly to demonstrate technical competence alongside the institutional fundamentals. Now, let's shift briefly to a technical snapshot. I want to be clear, this isn't a buy-sell signal. It's a way to understand how the structural tensions we've discussed are reflected in market mechanics. Think of it as confirmation of the stress, not an actionable trade. Starting with gold. If we look at relative strength index, RSI readings across COMEX futures, gold is hovering in the mid to high 50s. That's not extreme, but it does suggest that the market is digesting a lot of latent tension. RSI is a momentum indicator, so values in this range indicate balance with a slight tilt toward accumulation, consistent with physical demand exceeding paper market liquidity. Moving averages tell a similar story. Gold is holding above both the 50-day and 200-day moving averages, signaling that the intermediate and long-term trend remains upward leaning. Again, this is not a recommendation to buy. It's a reflection of steady accumulation and structural scarcity creeping into market pricing. Crossovers or deviations here can indicate pressure points if paper markets begin to reconcile with physical constraints. The Ichimoku cloud adds another layer of perspective. Gold futures are currently trading near the upper edge of the cloud. In Ichimoku terms, this suggests that short-term momentum is supported by longer-term trend alignment, a subtle confirmation of underlying systemic strength. The cloud also visually represents areas of potential support if volatility spikes, which is exactly the type of market environment we are discussing. Volume profile is particularly revealing. Gold futures show concentrated volume clusters around recent price levels, indicating that institutional players are actively positioning here. When volume clusters align with tight inventory conditions in the physical market, it's a signal that paper markets are reflecting systemic tension without yet fully repricing. This is the type of nuance most retail participants miss: the interplay between volume, price consolidation, and underlying structural stress. Silver offers an even more interesting technical picture. RSI for silver is slightly higher, in the mid-60s, suggesting that the market is closer to short-term overextension. That's consistent with the volatility we expect when industrial demand meets thin, deliverable supply. The 50-day moving average has recently crossed above the 200-day moving average, a classic golden cross pattern. Again, not a signal to act, but a structural marker. The market is positioning for potential catch-up to physical stress. Ichimoku clouds for silver show that the current price is trending above the cloud, reinforcing that short-term momentum aligns with medium-term scarcity signals. Volume profiles confirm that liquidity is concentrated around key price points, often coinciding with physical premiums in Asia and industrial buying in Europe. This reinforces our earlier conclusion. The physical versus paper divergence is real, measurable, and increasingly visible in market structure. It's also worth noting that volatility metrics, not always highlighted, are starting to tick higher. Both gold and silver show increasing implied volatility in futures options. This is the market's way of pricing in potential shocks without committing to an immediate repricing. When you combine this with inventory tightness, industrial demand, and geographic arbitrage, it paints a clear picture. The system is under pressure, and the technicals reflect that stress. To summarize this snapshot, gold RSI mid-50s, stable accumulation. Gold moving averages, trend support, not hype. Gold Ichimoku, short-term momentum aligned with longer-term trend. Gold volume profile, concentrated institutional positioning. Silver RSI mid-60s, higher short-term tension. Silver golden cross, structural positioning for potential repricing. Silver Ichimoku and volume, physical demand alignment and liquidity concentration. Implied volatility, market anticipating possible shocks, paper market stress visible. The takeaway here is subtle but critical. Technical tools confirm what the fundamentals already show. The markets are not overhyped. They are quietly reflecting the growing tension between physical scarcity, industrial demand, and paper market positioning. This is exactly the type of analysis that separates long-term strategic thinking from reactive, emotional trading. In the next section, we will pause and reframe all this data into a macro thesis, a single, coherent picture that links sovereign debt stress, paper versus physical divergence, and the potential for precious metals to assert themselves as strategic assets in the global system. This is where the aha moment comes into focus.